Modern accounting has its roots in ancient practices that trace back thousands of years. Recorded history, beginning with the advent of writing around the 4th millennium BCE, provides glimpses into the early accounting practices of civilizations such as those in Mesopotamia and Egypt. The earliest forms of record-keeping were often administrative in nature, focusing on the management of resources and trade. Cuneiform tablets from Mesopotamia, some of which date back to 2500 BCE, reveal extensive records of daily activities, trade transactions, and the bureaucratic organization of these early societies. In Mesopotamia, modern-day Iraq, clay tablets documented tax payments, trade transactions, and resource allocations. In Egypt, papyrus scrolls recorded financial activities like grain storage and trade. These early systems were single-entry, focusing on tracking inputs and outputs without balancing accounts. The first great civilizations, such as those in Mesopotamia and Egypt, contributed significantly to the evolution of accounting practices. Mesopotamian records are particularly notable for their sheer volume and longevity, with estimates suggesting that hundreds of thousands of clay tablets exist, covering various aspects of life over a period of about 3,000 years. These records not only chronicled the achievements and transactions of kings and merchants, but also provided insight into the daily lives of ordinary people, showcasing a sophisticated understanding of economic life. As historians began to analyze these ancient records, they identified the use of basic accounting techniques to facilitate trade and resource management. This early accounting was often closely tied to the temple economies, which served as centers of administration and economic control. The Romans developed more structured bookkeeping methods to manage their vast empire. They recorded revenues, expenditures, and taxes in ledgers. However, these systems lacked the complexity and precision of double-entry bookkeeping. The reliance on written records helped these civilizations maintain order and efficiency, laying the groundwork for future accounting systems. By the High Middle Ages, c. 1300, the written word became a more abundant source for historians studying Western history, facilitating the evolution of accounting methodologies. With the resurgence of interest in ancient texts during the Renaissance, scholars began to refine the techniques of accounting further. This period marked the transition from simple record-keeping to more systematic approaches that would eventually culminate in the development of double-entry bookkeeping in the late medieval period. The introduction of double-entry bookkeeping in the 15th century represented a watershed moment in accounting history. This method, which requires each transaction to be recorded in at least 2 accounts, provided a more comprehensive overview of financial activities and ensured that the books remained balanced. The evolution of modern accounting owes much to the foundational contributions of 2 key figures, Benedetto Cotrugli and Luca Pacioli. These innovators laid the groundwork for double-entry bookkeeping, a system that remains integral to financial management and business operations today. Benedetto Cotrugli, a merchant from the Republic of Ragusa, now Dubrovnik, documented the earliest known description of double-entry bookkeeping in his manuscript Della Mercatura e del Mercante Perfetto, On Trade and the Perfect Merchant. While his work emphasized the necessity of balancing debits and credits, it gained limited recognition and lacked widespread influence. Cotrugli's focus was not only on recording transactions, but also on the broader principles of effective trade and merchant conduct, making his manuscript a blend of accounting practices and ethical commerce. Nearly 4 decades later, Luca Pacioli, an Italian mathematician and Franciscan friar, formalized the double-entry system and brought it into broader use. In his seminal work, Summa di Aritmetica, Geometria, Proporzioni e Proporzionalità, the collected knowledge of arithmetic, geometry, proportion, and proportionality. Pacioli dedicated a detailed 27-page section to bookkeeping. This section outlined critical principles that have become the foundation of modern accounting practices. The double entry principle. Every financial transaction involves two corresponding entries, a debit and a credit, ensuring that accounts remain balanced. Structured record keeping. Pacioli introduced the use of ledgers, journals, and trial balances to systematically track financial activities. Year-end reconciliation. He emphasized the importance of closing entries at the end of each accounting period to ensure all accounts are balanced and accurate. Pacioli's work popularized double-entry bookkeeping and standardized its application, earning him the title Father of Accounting. His detailed explanations and practical examples provided a framework that merchants and accountants could adopt universally, cementing his pivotal role in the history of accounting. Together, Cotrugli and Pacioli laid the intellectual and practical foundations of accounting, transforming it from a rudimentary practice into a structured discipline essential for trade, commerce, and economic development. As businesses expanded during the Industrial Revolution, the need for accurate financial reporting became even more critical, leading to innovations in accounting techniques to manage increased transaction volumes effectively. The evolution of accounting principles reflects the changing needs of society and the complexities of business. Initially, accounting was primarily a method for recording transactions, with rudimentary practices developed by ancient civilizations such as the Mesopotamians, who used simple tracking methods for assets and liabilities. As commerce and trade expanded, the need for more sophisticated record-keeping became apparent, leading to the development of structured accounting systems in medieval Italy. The foundation of modern accounting theory is established through a series of basic assumptions and principles. Key assumptions include the monetary unit, economic entity, going concern, and periodicity, which collectively provide a framework for understanding and applying accounting practices. The core principles that emerged during this evolution, historical cost, revenue recognition, matching, full disclosure, materiality, and conservatism, form the bedrock of accounting theory today. These principles guide accountants in preparing financial statements that are both accurate and reliable. The Industrial Revolution brought significant changes to accounting practices as the rapid expansion of businesses required more detailed and standardized reporting methods. Accountants faced challenges in adapting to the complexities of industrialized businesses, prompting the emergence of new accounting systems designed to address these issues. The demand for transparency and accountability led to the establishment of Generally Accepted Accounting Principles, GAAP, in the United States, which provided a structured approach to financial reporting and compliance. The formation of professional organizations, such as the American Institute of Certified Public Accountants, AICPA, played a crucial role in developing and standardizing accounting practices. These organizations arose in response to the increasing complexity of business transactions and the necessity for uniformity in financial reporting. As businesses grew and international trade expanded, the need for consistent accounting standards became increasingly clear, leading to global efforts aimed at harmonizing accounting practices. The late 20th and early 21st centuries marked a significant shift towards the adoption of international financial reporting standards, IFRS, as globalization accelerated. IFRS facilitates a common accounting language, enhancing comparability and transparency across borders. While many countries embraced IFRS, the United States continued to rely on GAAP, reflecting the unique regulatory environment and economic context of the nation. Nevertheless, the convergence of these standards remains a topic of ongoing discussion, as both frameworks aim to improve the reliability and clarity of financial information. As technology has progressed, so too have accounting practices. Today, accounting increasingly utilizes digital tools, such as cloud storage for data management and artificial intelligence for data analysis, allowing for real-time insights and more strategic decision-making. Additionally, innovations like blockchain are being integrated into accounting to enhance transparency and security in financial reporting. The landscape of accounting is continuously evolving, with new trends emerging in response to changing business environments and societal needs. Modern accounting practices now incorporate sustainability reporting, emphasizing the importance of environmental accountability alongside financial performance. As accounting continues to adapt to new technologies and methodologies, its fundamental principles remain rooted in the need for accurate, transparent, and timely financial information, ensuring its relevance in the ever-changing business world. Over the past several decades, the role of accountants has undergone a transformation from mere record keepers to key strategic partners within organizations. This change was driven by the increasing complexity of financial regulations and the growing need for businesses to leverage accurate financial data for decision-making. As a result, accountants are now expected to possess a blend of technical skills, including data analysis and financial modeling, as well as soft skills such as communication and interpersonal abilities. Modern accounting is increasingly recognized as a technical, social, and moral practice that requires a broader consideration of accountability. The question of who is accountable and to whom is central to contemporary accounting discourse, with many interested parties relying on financial reports for their decision-making processes. This shift towards greater stakeholder engagement emphasizes the need for accountants to address the needs of diverse user groups while balancing conflicting interests. If you enjoyed this video, don't forget to like it, subscribe for more fascinating stories, and share your thoughts in the comments below. You can also support us on Patreon, link below.